Want to invest in India's startup boom? Awesome! Let's jump right into this explainer and decode exactly how you can tap into this massive ecosystem without, getting caught in the regulatory crossfire.
A lot of non-resident Indians and overseas citizens want to become angel investors. And honestly, it's easy to assume it's just like buying listed shares on the stock market, right? You see a brilliant idea, you write a check, and then you just sit back and wait for that unicorn valuation. Well, not quite.
Here's the harsh reality check. Don't let FEMA mistakes derail your investment. Startup investing is a totally different beast. Your investment is actually subject to a really complex web of regulations. We're talking the Foreign Exchange Management Act, sector-specific FDI policies, and some incredibly strict reporting rules. Honestly, a single compliance mistake here can literally derail your entire financial plan.
So to make this super clear, we've broken this explainer down into a 6-part roadmap. First, the NRI startup opportunity. Second, navigating FEMA and FDI. Third, valid investment instruments. Fourth, mandatory RBI reporting. Fifth, capital gains and DTAA. And finally, structuring your exit. Let's get into it.
Okay, part 1, the NRI startup opportunity and how to tap into the ecosystem.
So under FEMA, NRIs and OCIs are absolutely legally permitted to invest in Indian startups. You can do this on a repatriatable basis, which basically acts as foreign direct investment, or a non-repatriatable basis. But here's the absolute kicker. You are not a passive domestic investor. In the eyes of the law, you're a person resident outside India. And because of that label, every single transaction that alters your equity holding brings some very strict compliance implications along with it.
Moving on to part 2, let's navigate FEMA and FDI, which can feel a bit like a regulatory labyrinth.
When you're bringing capital in, you basically have 2 main entry pathways. Now, most investors play in what's called the automatic route. This is great because you don't need prior government approval, and up to 100% FDI is allowed in prominent sectors like IT, SaaS, and e-commerce. The startup simply receives your funds and reports it. But if the startup operates in specific restricted sectors, bam, you hit the government route. This means you need strict prior clearance from the relevant ministry and the DPIIT before a single rupee can even be transferred.
Right, part 3, valid investment instruments. Basically, the vehicles for your investment.
So, what exactly are you actually buying? Well, traditional equity shares give you direct ownership, but they require an immediate valuation. And as you can imagine, that's notoriously difficult for pre-revenue ventures. So instead, you'll often see CCPS, compulsorily convertible preference shares, which delay that valuation. But a really fascinating vehicle is the convertible note. If a startup is officially government recognized, they can issue this note which acts as debt initially and then converts to equity later on. But watch out for this rule. For foreign investors, it requires a minimum investment of 25 lakh rupees in a single tranche to be valid.
Which brings us to part 4, mandatory RBI reporting, or as I like to call it, the compliance trap.
Once you've invested, you have to follow this exact sequence perfectly. Step 1, remit your funds through proper banking channels so an authorized dealer bank can issue a remittance certificate and a KYC report. Step 2, make sure the startup allots your shares within exactly 60 days of receiving that money. And step 3, which is absolutely crucial, the startup must file Form FCGPR on the RBI's portal within 30 days of that allotment. They will also need a valuation certificate for this. Oh, and keep an eye on the 90-day freshness rule. If that valuation certificate is older than 90 days, it completely breaks the filing.
Now, alongside FCGPR, startups also have to stay on top of a few other major filings. There's Form FCTRS, which gets triggered within 60 days if shares are transferred between a resident and a non-resident. Then there's the annual FLA return, which is due every July 15th. And hey, if you use that convertible note we just talked about, the startup has to file Form CN within 30 days of issuance.
So why does all this paperwork matter so much? Because startups routinely miss these filings. This happens all the time, especially when founders holding shares in their own startup forget they're technically classified as a resident outside India. And missing these deadlines triggers a continuing default penalty of 5,000 rupees per day, literally every single day. Under FEMA rules, base penalties can reach 2 lakh rupees or up to 3 times the entire transaction amount.
And look, if a mistake happens, and let's be real, they do, it has to be regularized. You can do this through a late submission fee, or, for the really complex issues, formal compounding with the RBI. But here's the stark reality. Compounding is incredibly expensive, and it can add months of delay to a startup's due diligence during their next VC funding round. It is a massive drag on their momentum.
Okay, let's look at part 5, capital gains and DTAA. This is all about protecting your treasure.
Assuming your startup hits it big and it's time to exit, your holding period is basically everything when it comes to your tax bill. Holding unlisted startup shares for up to 24 months triggers short-term capital gains. Those get added right to your total Indian-sourced income and get taxed at your individual slab rates, which could be up to 30% plus surcharges. Ouch. But holding those same shares for more than 24 months unlocks long-term capital gains, which are taxed at a much more favorable 12.5% rate.
Now, to avoid getting fully taxed in India and then taxed all over again in your home country, you have to leverage a Double Taxation Avoidance Agreement, or DTA. This is a bilateral treaty that figures out which country actually gets to tax specific types of income. But here's the catch. You can't just verbally claim it. You absolutely must have a physical tax residency certificate, a TRC, from your country of residence to prove that you qualify.
Just to show you how wildly specific these treaties can get, let's look at the India-UAE DTAA. Under one specific article, direct startup shares are fully taxed in India. So if an NRI in Dubai exits with a one-core long-term gain, it gets taxed in India at 12.5% plus surcharges. The treaty just does not protect direct equity there. However, under a completely different residual clause, mutual fund units are effectively tax-free in the UAE because Indian mutual funds are structured as trusts. It's wild, right? And it perfectly illustrates why understanding the exact wording of the treaty for your specific asset class is absolutely mandatory.
Which brings us to our final piece, Part 6, Structuring Your Exit, and essentially, the solution. The biggest takeaway here is that planning your investment structure from the very beginning makes your eventual exit so much smoother. Way before you exit, you need to ensure you have proper valuation certificates, a secured tax residency certificate, and that you filed Form 10F. If you don't have these locked down, Indian banks and buyers will automatically deduct tax at source, TDS, at the absolute highest rate, and you'll just be left fighting for a refund for years. Nobody wants that.
The opportunity for wealth creation in India's startup ecosystem right now is massive. Really, it is. But it requires absolute legal precision. If you don't build the right compliance architecture on day one, your amazing unicorn exit could literally turn into a regulatory nightmare. So as you look at your next big startup pitch, I want you to ask yourself, are you just ready to write the check? Or are you actually prepared to invest smart and stay compliant?